Joining us now is Erin Browne of PIMCO, who published her asset allocation outlook today, Erin, and likes bonds. Is this a big shift for you guys at PIMCO, now embracing bonds after they've had a terrible year?
Yeah, it has been. I mean, throughout most of this year, we have been underweight bonds, and we are now starting to shift to see value within certain segments of the fixed income market, particularly those that are higher quality, that offer good return with very low default risk probability. And we think that those bonds will start to outperform in the year ahead, particularly given the starting levels for fixed income yields, which for a cash rate is about 4%. And you take a little bit more risk for high quality corporate, and it's about 5.5% to 6%. That's a really good return relative to what you can expect to earn across riskier asset classes next year.
Is that a recession call?
It is a recession call. We do think recession is more likely than not into 2023, likely hitting early 2023. And we see that as, pretty high probability in the U.S. and very high probability across Europe and the UK. And we think as a result of that, you're going to have duration start to perform better as you move deeper into a recession. And that certainly is underpinning a lot of our call for next year.
So what does it mean for stocks? Because stocks sort of have they've been actually doing better when you see bonds catch a bid lately. It's really been the opposite for most of the year, where stocks and bonds sell off together. So ultimately, is this constructive for stocks as well?
So in late cycle environments, it's typically an environment where bonds do poorly and where equities do okay on a relative basis. As you start to move into a recessionary environment, that's where the scales really tip in favor of fixed income and owning fixed income in portfolios relative to equities. And we think we're at that tipping point right now as we turn the page into early next year. We think that equities are going to continue to remain weak, but bonds should start to deliver positive returns as we move deeper and deeper into recession. And that negative stock bond correlation will reassert itself in 2023. That certainly is one of the things that's underpinning our view. For equities specifically, it's very hard to invest in equities if you have bond volatility as volatile as it is today. So we need to see the core, the fixed income asset core, stabilize before you can start even thinking about investing in equities. Beyond that, you also need to see earnings be more reflective of a recession. And right now, forward earnings for the S&P 500 are still up 6% versus historical recessions where earnings fall 15% during a recession.
Are you getting anything from any of these Fed comments that move the needle one way or the other? I mean, clearly they're not all exactly, I think, on the same page in terms of how much they want to hike rates and how strongly and how quickly. But overall, it feels like nobody wants a pause yet. They still feel like they have work to do, but they are paying attention to some of these better inflation readings and worse readings on the economy.
Well, so first, keep in mind that over the past year, we've had two sort of fits and starts of inflation, thinking that we've all thought that inflation sort of peaked, and yet we saw inflation accelerate to the upside thereafter. So I think we're still very tentative and in early days of making any, big call with respect to inflation. And I think the Fed is probably in a similar camp. Second, inflation, even when it does peak, is not expected to come down, rapidly, and certainly not expected to be, falling back down to within their central bank sort of target for 2% inflation, plus or minus. So even after we see inflation peak, we expect that it's going to remain persistent. We expect that it's going to remain sticky and elevated. And so that's going to also create a challenge for the Fed to, sort of navigate around this environment. The third thing is we've had a significant sort of re-rating in both stocks and bonds since the CPI print. And I think the Fed is also cognizant of that. They don't want financial conditions to ease. They want them to remain tight. And so they do have this challenge that the more financial condition easing we see, the higher they're going to have to hike rates. And I think that they're trying to keep that framework in mind as they sort of,
don't let the market get too excited
in the last few weeks. Yeah, exactly.
Right. Erin Browne, thank you very much for joining us on the new strategy from PIMCO.